You open your banking app and see a number you have been working toward for months, maybe even years: $10,000. For the first time, you feel like you are finally getting ahead. You resisted unnecessary purchases, controlled your spending, and consistently saved part of every paycheck. But then a new question appears. What are you supposed to do with that money now? Should you leave all $10,000 in savings? Should you invest it in the stock market? Should you pay off debt? Or should you divide it between all three? Because keeping every dollar in cash could limit its long-term growth. But investing every dollar could leave you financially exposed when life goes wrong. And this is the mistake many people make after reaching their first major savings milestone. They think they need to choose between saving and investing. They don't. They need to give each dollar the correct job. In this video, I'll show you a practical step-by-step system for deciding how much of your $10,000 should remain protected, how much may be used to improve your financial position, and how much could begin building long-term wealth. We will also follow a realistic example so you can see how someone might divide the money without gambling with their financial security. But first, you need to understand something that could completely change the way you look at your savings. Having $10,000 does not automatically mean you have $10,000 available to invest. Protect your financial foundation. Imagine someone named Daniel. Daniel has successfully saved $10,000. His essential monthly expenses: housing, food, transportation, insurance, and basic bills total approximately $2,000. He also has $2,000 of high-interest credit card debt, and his employer offers a retirement plan match. At first, Daniel thinks he should invest the entire $10,000. He has watched videos about index funds, compound growth, and retiring early. He is worried that every month his money remains in savings. He is missing an opportunity. But before Daniel invests anything, he needs to ask 4 questions. What is this money protecting me from? When will I need it? What expensive debt am I carrying? And, do I already have access to benefits that can help me invest? Those 4 questions are more important than finding the next popular stock. Step 1. Keep a real emergency fund. Your emergency fund is not lazy money, it has a job. Its job is to prevent one unexpected event from destroying the rest of your financial plan. Your car breaks down. You lose your job. A medical expense appears. Your rent increases. A family emergency requires immediate travel. Without emergency savings, you may be forced to use a credit card, take an expensive loan, or sell investments during a market decline. That is why emergency money normally should not depend on the stock market being in a good mood when you need it. Many people aim to keep approximately 3 to 6 months of essential expenses available in cash. But that range is not a commandment. Someone with stable employment, 2 household incomes, and strong insurance may feel comfortable toward the lower end. Someone who is self-employed, supports a family, or works in an unstable industry may need more. In Daniel's case, 3 months of essential expenses equals $2,000 multiplied by 3, $6,000. That means at least $6,000 of his savings already has an important job. It is protecting his rent, food, transportation, and other essentials if his income suddenly stops. This changes the entire calculation. Daniel does not really have $10,000 waiting to be invested. He has approximately $6,000 of safety money and $4,000 that still needs to be assigned. That mental separation is powerful. Do not look at your bank balance as one pile of money, divided into 3 buckets. Bucket 1, emergency money. Bucket 2, money for goals you may need within the next few years. Bucket 3, long-term growth money. The first bucket protects you. The second bucket pays for planned expenses, such as a car, education, moving costs, or a home deposit. Only the third bucket should normally be exposed to significant long-term investment risk. A person saving for retirement in 30 years can usually tolerate more short-term market movement than someone who needs the money for a house next year. The investment decision starts with time, not excitement. Step 2. Examine high-interest debt. Daniel still has $2,000 of credit card debt. Suppose that debt charges around 22% annually. If Daniel carries the balance, the interest could cost him hundreds of dollars over time. He could invest the $2,000 and hope the market performs well. But there is no guaranteed investment return that automatically cancels an expensive credit card rate. Paying off high-interest debt can therefore be one of the strongest uses of available money. Notice that this does not mean every debt must disappear before you invest. A low-rate mortgage is different from a credit card charging more than 20%. The important questions are, what interest rate are you paying? Is the debt growing quickly? Does it create monthly pressure? And what would become possible if that payment disappeared? In Daniel's case, using $2,000 to eliminate the credit card balance would leave him with $6,000 for emergencies. No expensive credit card debt. $2,000 still available. He has not become poorer by paying off the debt. He has improved his monthly cash flow and removed a guaranteed expense. This is one of the major gaps in many beginner investing videos. They show you what an investment might earn, but they ignore what expensive debt is already taking from you. Step 3. Check for an employer match. Before opening a random investment account, check whether your employer offers a retirement plan and whether it includes matching contributions. A match means the employer may contribute additional money when you contribute according to the plan's rules. For example, a company may add a percentage of what an employee contributes up to a specific limit. The exact formula differs between plans, so you need to read your plan documents rather than assuming how it works. In Daniel's case, he discovers that his employer offers a match. Instead of trying to fund everything directly from the $10,000, he adjusts his monthly payroll contribution so he can make use of the available match. That matters because the $10,000 is not the only part of his financial system. His future paychecks are also part of the plan. The goal is not simply to invest one pile of money. The goal is to build a repeatable process that continues after the original $10,000 has been assigned. At this stage, Daniel has done 3 things. He has protected 3 months of essential expenses. He has removed his high-interest credit card debt. And he has started using the retirement benefit available through his job. Only now is he ready to decide what to do with the final $2,000. If you like finance explained through realistic decisions instead of overnight rich promises, subscribe to the channel. We are building practical systems that ordinary people can actually follow. But Daniel's next decision is where many beginners become confused. Because choosing an investment and choosing an investment account are not the same thing. Turn the remaining money into a long-term system. Think of an investment account as a container. The investments are what you place inside that container. A workplace retirement plan, an individual retirement account, and a taxable brokerage account may all hold investments, but they can have different tax treatment, rules, and withdrawal restrictions. This is why you should not begin by asking, which stock should I buy? Begin by asking, what is this money for, and which type of account suits that goal? Money intended for retirement may belong in a retirement-focused account. Money intended for a flexible long-term goal may require a different account, and money needed soon may not belong in the stock market at all. This video is general education rather than personalized financial advice. Taxes, account rules, and suitable investments depend on your country, income, goals, and personal circumstances. Step 4. Choose something simple and diversified. Once Daniel has selected an appropriate account, he must decide what to own inside it. This is where social media can make investing look much more complicated than it needs to be. One person recommends a technology stock. Another says cryptocurrency will replace the financial system. Someone else is showing screenshots of a successful options trade while hiding the unsuccessful trades. Daniel does not need to predict which company will dominate the next decade. He needs an investment strategy that he can understand, afford, and continue during difficult markets. One beginner-friendly option to research is a diversified, low-cost index fund. An index fund follows a particular market index. Some broad market funds hold shares in hundreds or even thousands of companies, allowing the investor to spread company-specific risk. But the word index does not automatically mean safe or diversified. A fund could track the broad market, or it could focus on one narrow industry. That is why Daniel checks. What index does the fund follow? How many companies or assets does it hold? Is it heavily concentrated in one sector? What fees does it charge? What risks are described in its documents? Fees may look small, but they continue being deducted year after year. The goal is not to find a fund with the most exciting recent performance. Last year's winner may not be next year's winner. The goal is to choose an investment that fits the plan and can be held consistently. Step 5. Decide whether to invest immediately or gradually. Daniel now has $2,000 of long-term growth money. Should he invest all of it today or divide it across several months? This is where there is no emotionally perfect answer. Investing the full amount gives the money more time in the market, but the value could fall immediately after the investment. Investing gradually may feel more comfortable because Daniel enters the market in smaller amounts, but part of the money will remain uninvested for longer. The most important issue is not finding the strategy that guarantees the highest return. No such guarantee exists. The important issue is choosing a reasonable plan that Daniel can follow without panicking. Daniel decides to invest $500 now, and then invest another $500 each month for the next 3 months. Could another person invest the full $2,000 immediately? Yes. Could someone with very low risk tolerance move more slowly? Yes. The decision depends on the person's time horizon, emotional comfort, and overall financial position. What Daniel should not do is invest based on daily headlines. If the market rises, he should not suddenly chase it. If the market falls, he should not automatically abandon the plan. He should follow the schedule he chose when he was thinking calmly.